Hello everyone, welcome to Just Invest Today, and in today's video we are going to compare Chinese tech to American tech. What is the better buy right now in this market after these huge sell-off, man? And we have to get down to the bottom of this because Charlie Munger came out at the Berkshire Annual Meeting 2022 and said he bought Alibaba because he thought he can get more for his money pretty much. He thought Chinese companies were cheaper than American tech companies. So that's why he bought Alibaba. So we're going to get into in this video. We're going to compare the two. I want to hear from you guys. What's cheaper? Alibaba, Amazon, Apple, whatever it is, Tencent, JD.com, Microsoft, whatever big tech out there you have. What do you think has the best value right now? But in this video, we're just going to compare Amazon to Alibaba. Let's hear what Charlie Munger had to say about this.
Those are good questions, and there's no question about the fact that the government of China has worried the investors from the United States who invest in China more in recent months and years than he did in earlier periods. So there's been some tension, and it's affected the prices of some of the Chinese stocks, particularly internet stocks. Just in the last day or two, the Chinese leader has sort of reversed course on that. Said he went too far and he's going to pull way back and so on.
So that is very key because he's saying that the government is going to pull back on his tech crackdown, and that has a huge effect on Chinese companies going forward because he wants that GDP growth to be very high, Xi Jinping. So new China policies to support big tech platforms and innovation globalization, official newspaper says. So this is huge because if you're living under a rock, you know that these Chinese companies have been getting killed in the market because of this crackdown on top of all this delisting risk. And we hear that the government is going to be working with the US, kind of handling all that delisting and all the auditing stuff. That's going to be handled. So this is my perception of Alibaba being cheaper because looking forward, if the government does what he says and kind of goes back to normal, Alibaba can succeed and over succeed in my opinion. But that's a big question, and that's why people don't really believe in Alibaba, because people still think that the government is going to kind of hinder Alibaba's growth moving forward and that they have more competition, etc., etc. for all these Chinese companies, JD, Tencent, everywhere. So that's one big factor that you have to kind of take in when you're thinking about these valuations.
So we're having some hopeful signs. But yes, there are more difficulties dealing with the regime in China than there are in the United States. And it's different, it's a long way away, and they've got their own culture and their own loyalties and so on and so on. And the reason that I invested in China is I could get so much better companies at so much lower prices, and I was willing to take a little political risk to get into the better companies at the lower prices. Other people might reach the opposite conclusion, and everybody is more worried about China now than they were 2 or 3 years ago.
So Munger is able to actually take on this political risk to get cheaper companies. But you might reach an opposite conclusion. You might think that it's too much risk and that American companies are actually far better because they don't have that risk associated with them and they're getting cheaper at the moment's notice because of this crash. So there's two different views to this. That's why I want to hear from you guys. What do you think is cheaper at this moment? We're going to analyze these stocks right now. So tell me down below, what do you think is cheaper? We're going to do just Amazon, Alibaba. You can kind of put your input on Apple, on Microsoft, on Tencent, on JD.com, whatever you see fit in the comment section. Alibaba is selling at $255 billion right now. And you have to think about this too. 27% of their market cap is just cash. They have around $70 billion in cash. So just keep that in mind when you think about the valuation for Alibaba. So they have $70 billion in damn cash. Right now, if we were to buy the whole company, that's how we got to think about businesses. We are business owners. We want to buy the whole company. Just like if you buy a farm, if you buy a house, an apartment house, whatever it is, a business, that's how we want to think about it. So I'm going to pay $255 billion for Alibaba. I'm going to get around $20 billion, $25 billion in free cash flow. So that's an 8% yield. 8% yield in this market is freaking phenomenal. It's amazing. I'm getting 8% of my money back, which is crazy. So that's an amazing yield right there. So that's how you can already know that right now Amazon is selling for a yield around 2% because Amazon, $1.1 trillion and is generating around kind of the same 30 billion cash from operations or free cash flow, but some years it's not profitable because they spend way more in capital expenditure. So I'm giving them the benefit of doubt of them generating 30 to 35 billion when they're not doing all those amazing expenditures. So 2% compared to 8% yield on your money. There's no question what's cheaper at the time. And we already see only from the high from 3,600 dropped 36%. So that's a huge kind of drop. But when you compare it to Baba, it's not even close. Not even close. 69% decline. And you have to think about this. We are going to get our generation, are we going to get the stock appreciation from the earnings growth, the earnings expansion, we're going to get it from share buybacks, right? And we're going to get it from a PE expansion or a multiple expansion. So that's where our returns are going to come from. So keep that in mind. So when it comes to earnings growth, what do you think is going to generate more earnings? We can see that Amazon has been doing amazing. I'm not even going to lie. 1 year, 21%. Past 5 years, 27%. Past 10 years, 25%. Cash flow growth, 13%. Past 5 years, 10 years, 82%. And in this year, 156% negative. So we can kind of see maybe 10 to 15% going forward because these companies are already huge and they have a strong base already. And then when you come to Baba, 40% 1 year revenue growth, 5 year past revenue growth, 46, 10 years, 49, cash flow, 39, 32, 45. So I'm not going to say that's going to go on to the future, right? Because that's a high hurdle. I'm going to give it the same earnings growth, 10 to 12% maybe, in that range, 10 to 15% for both Alibaba and Amazon. Is that fair? Tell me if that's fair. Or do you see Amazon growing way faster than Baba? I don't know. Who knows? Tell me what you think down below. So getting back to Baba, so we have that right there, earnings growth. Then we have share buybacks. Alibaba's doing $25 to $50 billion worth of share buybacks. So that's gonna help the multiple of Alibaba because they're reducing the share count. They're gonna reduce the amount of people they have to feed with their earnings. So that's an amazing thing that Alibaba has up against Amazon right now. So we can see why it's kind of cheaper, right? And then on top of that, we have multiple expansion. Whose multiple do you think is going to have an expansion? Who really knows who's going to have the significant multiple expansion because that's all depending on the market. But in my opinion, it's going to be Baba because it's already down 69%. So they have a long way to go to kind of recover. So I see a stronger multiple expansion from Baba. Tell me if you disagree or agree. So now when we come to the company, overall the company, the moats, who has a stronger moat? Who has a stronger company? Who has stronger gross profits and margins and all of that good stuff? So let's go to the margins. Gross margins, 60%, 63%, 57, 45, 45, 41, 37%. So you kind of see that dropping off. So you see the margins of Baba dropping off. But if we kind of see that the regulations, the tech because this is all because of the tech crackdown in my opinion. So if we see that kind of tech crackdown kind of easing off, do you think Alibaba can recover? That's a huge question, but I think that's going to have a lot to do with Baba getting back to kind of where it was in the past. Now let's go to gross margins for Amazon. 37%, 40%, 41, 39, 42, 42. So it's more consistent, but pretty much the same. So gross margins pretty much the same. Operating margins 2%, 5%, 5, 4. So let's see what Baba's operating margins are going to be. 30, 28, 16, 18, 15, 10. So you see Baba's operating margins dropping off and Amazon's margins kind of being steady, but they've always been kind of low. with Baba, I'm seeing this going to be able to recover hugely because with the tech crackdown, it affected Baba like crazy, and they're getting into more like fulfillment. They're building out more stores. They're doing more acquisitions and stuff like that. So I can kind of see this operating margins improving back up to the 15%. And if they do that, that's going to drive a lot of their revenue and a lot of their growth, in my opinion. So I think they have a higher base to grow compared to Amazon. Amazon's margins are not going to improve that much, but Baba has a chance to improve their margins like crazy, in my opinion, right? So we see the margins of the business, I think, are better for Alibaba. We see past growth for Baba better, but I'm not saying that's going to be future growth. Amazon is not buying back their shares, which is a huge advantage for Baba. And on top of that, the balance sheets, I can say they're kind of the same. $66 billion for Amazon. And what do we have here? For Baba, we have 77 billion. So pretty much kind of the same in that segment. Now let's go to valuation metrics. Price to sales. What's the price to sales for Alibaba? Alibaba is selling at 1.9 price to sales. Crazy. Let's see what Amazon is selling for right now. It's selling for around 2.3 price to sales. So kind of the same. So I'm not going to kind of hinder that. But the biggest thing is the margins, the free cash flow margins, because we are all about cash and cash generation. That's all about investing. That's what investing is. Putting money down today to get money back into the future. So yields, you're getting a 2% cash flow yield, and Alibaba, we're getting an 8% cash flow yield. But now it comes to the moats in the company. What do you think is a better company? And that's going to generate that consistency, that strong company into the future. Do you think Amazon has a better moat? Remember, Amazon has Twitch. They have their advertising business. They have AWS. They have third party. They have first party. They have Prime. They have movies. Like, they're a juggernaut when it comes to moat and their whole they have the fulfillment. The fulfillment is gonna kind of get after FedEx, which is insane, man. Like, Amazon's moat, I think, is way better than Baba, and that's how we can kind of see that maybe Amazon's actually cheaper. If you maybe think about the whole company and the whole moat, maybe Amazon's cheaper, because with Baba we have Taobao, Tmall, we have Lazada, we have Trendable, Cloud, we have Ant Financial. So is that section stronger than Amazon section that I just mentioned? Like, I don't think so. That's a hard ask for Alibaba to be competing with Amazon with all those strong kind of segments of their business, man. So what do you think is cheaper? What do you think is a better price? What do you think is going to be a better buy now that you can kind of see into the future will be a better company, man? So tell me what you think, man. These are two strong companies. What do you think is cheaper, Alibaba or Amazon? Because it's all depending on where you see the company in 5 to 10 years. So please like this video and subscribe to my channel. I'm always providing you guys with so much new content. Peace!